Treasury officials signaling potential use of a near-down $1 trillion account to buy bonds could ease pressure on yields and support rate-sensitive holdings for Canadian investors. This is Modern Investing Techniques, episode 150. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. The S&P 500 closed at 7,677, up 0.3%. The Nasdaq Composite finished at 26,151, up 0.7%. The TSX Composite ended at 36,958, also up 0.7%. Bank stocks led on the TSX even as tariff concerns lingered. The nearest Federal Reserve decision sits weeks away, while the Bank of Canada holds its next meeting in September, with markets pricing limited near-term cuts. Our simulated portfolio shows a cumulative profit of $236.89 across 54 trades at a 54% win rate. The matched window alpha versus the Nasdaq sits at negative 4.5% across 3 rules-based trades. Option spreads can turn a single contract directional trade into a lower cost structure by selling a second contract against the first. Today's market shows how this approach defines risk upfront while still capturing the core thesis, though it caps upside if the move exceeds the short strike. A listener holding one long call on a rebounding name could sell an out-of-the-money call at the same expiration to reduce net debit and create a defined risk debit spread. The trade-off appears clearly in back-tested one-contract examples, where the spread lowered entry cost by roughly 30 to 40% on average, but limited gains once the underlying moved beyond the short leg. This mechanic works best when volatility is elevated enough to inflate the credit received on the short side. Risk rises if the spread is held through binary events that produce gap moves beyond the strikes. Disclaimer: this is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today's practice investment is a flash trade on HPS.A, Hammond Power Solutions, listed on the TSX in the industrial sector. The approach uses a valuation entry on pullback into data center infrastructure spending, with a 5-session hold and an 8% stop. The catalyst is accelerating Canadian data center build-out demand for electrical equipment, with the name already trading at a discount to recent highs. Price pulled back from 52-week highs with volume near the 20-day average and nearest support at the 50-day moving average. The stop limits loss on the $1,000 position to roughly $80. The target is 4 to 8% over the 5-session window if the infrastructure spending narrative holds. This is a medium confidence setup because the fundamental spending trend is visible, but volume confirmation remains average rather than elevated. The invalidation line is clear. The thesis fails if quarterly revenue guidance from data center customers falls below the prior quarter's run rate. This setup demonstrates how to screen for names already discounted after sector rotation, yet still tied to a multi-year spending cycle. Yesterday's flash trade on GMIN.TO entered at $54.47 on the Tuesday open and exited at $56.33 at the close. The position gained 3.41% or $34.15 on the $1,000 allocation. The same-day exit captured the immediate reaction without giving the position time to reverse on profit-taking. That outcome aligns with the rule requiring volume above the 20-day average before entering any catalyst-driven name already in a sector rotation. The option spread builder in Growth Lab walks users through converting a one-contract directional idea into a defined risk spread by selling a second contract at a higher strike. It displays the reduced net debit, maximum loss, and capped gain in real time so investors can see the exact trade-off before placing the order. Canadian listeners comfortable with options can access it through the Options Play Growth Lab subscription tier. The TSX 60 ETF screener yield tool pairs an 8.90% screener yield with a 13.68% one-year total return, giving investors a quick way to compare covered call exposure against plain vanilla TSX trackers. Users can run the same screen on any brokerage platform that offers ETF screeners filtered by distribution yield and 1-year return. The number of IRA-created millionaires rose 16% year over year to 501,481, showing the power of consistent tax advantage compounding even in volatile markets. Review your own RRSP or TFSA contribution room and schedule the maximum annual transfer before year-end. Senior officials indicated the general account could fund stepped-up purchases of government bonds, a move that could cap yield upside. Hold CAD cash or short-duration bond ETFs until the first Treasury auction after the announcement to gauge flow impact. The Australian uranium producer Paladin Energy published its annual report and management discussion, giving investors fresh production and cost data. Add pdn.to to the watch list and compare the new guidance against the prior quarter's realized prices before considering any entry. Suppliers across the region posted gains as traders positioned ahead of tonight's Nvidia print. Avoid adding new tech exposure until after the earnings reaction settles and volume confirms direction. The show used to quote a cumulative alpha figure across roughly 45 trades. It is gone from the scoreboard, and that is deliberate. A number that quietly vanishes is the oldest tell in performance reporting. That figure blended trades whose entry and exit prices could not be tied back to the actual sessions the trade was held. An audit could not reproduce it, so it was not the show's to claim. The exit rule was the deeper problem. A position used to be closed on whichever session the next pre-market run happened to price it. So a Monday pick was held about 5 sessions and a Wednesday pick about 1. Per trade performance was measuring the day of the week as much as the quality of the idea. The hold is now a fixed, published number of sessions. Some older trades match no market prices at all, and they include the best and the worst results on the books. They stay published as history, flagged, and they are never blended into what the show says on air. What replaced it? From August 18th, 2026, every pick is scored under one written rulebook. Entry at the first session open on or after the pick, exit at the stop or at the fixed horizon. One position, $1,000, no discretionary exits. The rules and the full trade-by-trade ledger, including the losers and the voided picks, are published for anyone to check at the Modern Investing Performance page at naranetwork.com. An invitation to check with no destination is not an invitation. The honest cost stated plainly. The record is now small, so for the next several weeks the alpha number will be based on a handful of trades and will not mean much on its own. That is what an honest track record looks like early. Do not spin it. This is exactly how a listener should audit any track record they are shown. Ask when the record started and whether that date was chosen after the fact. Ask what the exit rule is and whether it was fixed in advance. Ask whether losers and abandoned positions are included, and ask whether the individual trades are published or only the summary. A record that cannot answer those 4 questions is a story. Portfolio performance, simulated $1,000 per trade. Lifetime totals show 54 total trades at a 54% win rate with 29 wins, 24 losses, and 1 break-even. Cumulative profit stands at $236.89. This record began August 18th, 2026, under the published rules. Earlier trades are history and are not blended into it. Too few trades to call an edge, a scoreboard, not evidence. Average return per trade is plus 0.44%. Best trade plus 20.11%. Worst trade negative 11.80%. Current streak is 1 win. Imagine you allocated $1,000 to a data center equipment aim last week after reading about accelerating infrastructure spend. Your order filled at the open, yet the position size represented 8% of the overall TFSA, rather than the 2 to 3% range that keeps single-name drawdowns manageable. The mechanism that actually determines survival is the interaction between position size and stop distance. A 7% stop on an 8% allocation creates a 0.56% portfolio hit, while the same stop on a 2% allocation limits damage to 0.14%. Professionals always calculate the dollar risk first, then backsolve for shares so that any single stop breach stays inside a preset daily or weekly loss budget. What most retail investors don't realize is that widening the stop to avoid getting shaken out simply increases the position size needed to keep dollar risk constant, which magnifies correlation risk across the rest of the book. The concrete misconception to avoid is treating stop placement as an afterthought once the entry price is chosen. Fix it by deciding the maximum portfolio loss you will accept on the idea before you ever click buy. Before we wrap, screen TSX listed industrials trading at least 10% below their 52-week high, and check whether the most recent quarter showed rising revenue from data center or infrastructure customers. That's it for today's modern investing techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. And if you'd rather watch than listen, find us on YouTube at Nara Network. Links in the show notes. One more thing. If you liked today's episode, our sister show OmniView is worth a spot in your feed, a balanced daily world news briefing that takes every side seriously. It's one of the Nara Network's daily briefings, all free at naranetwork.com. Live dashboards, TSLA, SpaceX launches, the investing scoreboard are all at naranetwork.com data. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't last?